I keep hearing ETFs and mutual funds are similar, but people make a big deal about choosing. What's the real difference?
Both give you a diversified basket of stocks in one buy. But ETFs trade like stocks all day, while mutual funds only price once after market close. That's the core structural split.
So if I buy a mutual fund, I can't sell it at noon? How does that affect me day to day?
Right, you place an order, but you get the end-of-day price. ETFs let you react instantly to news. For long-term investors, that rarely matters, but it's a big flexibility difference.
Got it. Now, fees, I've heard ETFs are cheaper. Is that always true, or just a myth?
Usually true, but not guaranteed. Many ETFs have expense ratios under 0.1%, while active mutual funds often charge 0.50% to 1%. But some index mutual funds are just as cheap. Always check the number.
What about minimums? I'm starting small, so that could decide things for me.
Mutual funds often require $1,000 to $3,000 upfront. ETFs you can buy one share, sometimes under $50. So for tiny accounts, ETFs win on entry cost.
Taxes sound scary. Why do people say ETFs are more tax efficient? Is that a real edge?
Yes, real edge. Mutual funds pass capital gains to you when the manager sells holdings, even if you didn't sell. ETFs use in-kind creation, so you avoid most of those distributions. Big deal in taxable accounts.
Can you give me a concrete example? Like, I invest $10,000 in each, what happens differently at tax time?
Say the mutual fund manager sells a hot stock, triggering a $1,000 gain. You owe tax on that. With an ETF, no such internal sale. You only pay tax when you sell your shares. That's the whole advantage.
So for retirement accounts like a 401k, does tax efficiency even matter? Or is that only for regular brokerage accounts?
In a 401k or IRA, taxes are deferred or tax-free, so the ETF tax edge disappears. There, focus purely on fees and fund quality. Mutual funds are perfectly fine in retirement accounts.
Okay, so if I'm a beginner with $500 to start, what's the smartest first move?
Start with a low-cost ETF that tracks the S&P 500 or total market. Buy one share, set up automatic investing if your broker allows fractional shares. That gets you diversified immediately with minimal fees.
But what if I want to invest automatically every paycheck? Don't mutual funds handle that better?
Good point. Many brokers now offer automatic ETF purchases with fractional shares, so that gap is closing. But if your broker doesn't, a no minimum index mutual fund from Vanguard or Fidelity works just as well.
Final question, if I had to pick one rule for choosing between them, what would it be?
Use ETFs in taxable accounts for tax efficiency and low minimums. Use either in retirement accounts, but pick the lowest fee. And never let trading flexibility tempt you into frequent buying, stay long-term.
That's super clear. So my takeaway, check fees, know your account type, and start with a broad index. Thanks, Jordan.
Exactly. And remember, both are great tools. The best choice is the one you'll stick with. Start small, automate, and let compounding do the heavy lifting. You're on the right track.